Welcome to the channel. We're going to look at 3 reasons why October is the bear market killer. Okay, October is the bear market killer. Let's take a look at the charts real quick. Let's just get straight into it, right? October 2020. Back here at the left, you see October was the low. The market bounced. 2020, October was the low, right? Going to 2022, October was the low. That's where we bounced last year, right? The bottom of the market. So the question is this year going to be the low going into October? Well, ending October, right? We're almost there. So is this going to be the low? And here's the first reason why. Let's throw this up on the chart, right? This is why this is the reason why October has typically been the bear market killer, or one of the reasons why October is a bear market killer, and it has to do with tax loss harvesting at the mutual fund. So basically, the mutual funds, their fiscal year ends in October. So if they already have a lot of losses in equities, if they have a lot of losses in the bond market, well, they're gonna sell. They're gonna collect their tax harvest, right? And you can see the chart right there, plain and simple. Let's go ahead and take this off. You can see the chart where historically, when you look in the orange against the historic average of the S&P 500, October usually ends there. And we looked at 2 different examples. So October number one, October is a bear market killer because of tax loss harvesting from the mutual funds, right? Now, that's something to keep in mind going forward, which means what? We have 2 more days. So I think buying starts to pick back up in November. We get the Fed meeting, right? We get the payrolls data, you get Apple earnings, and you possibly get the buyback starting to come. And it's like a cascade. It's not just, oh, okay, it's just the mutual funds. Everybody knows they're going to tax loss harvest, right? So it's a cascade. So that cascade should be reversing to the upside, especially because the market is oversold going forward. Now, number 2, let's get into number 2. Number 2 is peak bond yields. Okay, peak bond yields. And before we get into peak bond yields, right? Peak bond yields, let's talk about first why yields might be peaking here. Actually, let's look at the chart first. Let's take a look at the chart. This is the dollar, by the way. We need the dollar to ease a little further, probably roll over, and the dollar is showing up pretty weak. A lot of bearish divergence, so the buying pressure is falling for the US dollar, and you see the price action struggle to break out. So I think that's going to go lower, but when I say bond yields, we're looking at 30-year bonds, we're looking at 10-year bond yields, right? And the reason I think, well, we have the Fed coming up, right? If they do pause, that could get bond yields lower, of course, but going back to the chart, and we're going to talk more because this is probably the biggest catalyst for the market. We do need bond yields to peak out here. All right. But the example I have is, so far, long rates, 10-year and 30-year rates have shown actually a softer reaction when you get hotter than expected data. So the data I have up here that we've gone through, the business cycle over the past 2 weeks have been hotter GDP. Third quarter came out at 4.9% versus 4.3, much hotter than expected. Bond yields did not budge. They did not make a new high. Consumer spending came in hotter than expected. Bond yields didn't move. Okay, 1-year inflation expectations exploded, probably because the fears of the war, making oil go higher, geopolitical risk, and then higher gasoline prices. But oil, I'm sorry, not oil, but yields didn't move. So yields are still capped right now at 4.8, the 30-year, 10 years at 4.8% as we speak. They capped out just above 5%. Okay, and then PCE came in hotter than expected month on month. Still, rates did not go higher. So rates are responding, bond yields at least, are responding weaker, right? That's some sentiment that tells you something. They're responding weaker when the inflation data is hotter. So what happens when you get a downside surprise? What happens when you get growth coming back down? And before we visit this issue, why is this the bigger issue? We're going to get to the third reason too. We're going to revisit the third issue. But before we get to the third issue, let's take a look. We're going to look at this clip really quick. So the reason why bond yields are so important here, because we don't know what's going to happen. But here's some insight on one of the best podcasts I like, The Compound, on why bond yields should be peaking at this point. Let's take a look in.
This is always like the threat. If governments aren't disciplined, eventually the market will discipline them in the form of bond buyers refusing to show up and or selling off their bonds.
So basically, because the government is spending so much, right, for the war, if Fed Powell doesn't tighten the markets, well, the bond vigilantes, right? A vigilante is somebody who does the work for the authority who is not an authority. So the bond vigilantes are saying, okay, well, if you're going to keep creating more debt, then we're going to sell that debt because you're reducing the value of the bond that we hold. So they're selling their bonds off, and what that does is literally push rates higher. You see the 10-year has been pushing up, tremendously. This is the biggest risk that the market has been facing this whole year, which is higher bond yields. Not so much the Fed, because the Fed is pretty much done tightening, but higher bond yields, right? And the bond vigilantes are basically, shorting bonds in order to say, hey, we're going to do the tightening for the Fed if they don't want to do it. So that gets the Fed pausing. Now, here's why I think we're at peak for rates, right? Other than the fact that we just talked about, right, which is bond yields are no longer responding as strong to hotter data, whether it's growth or whether it's inflation. It is not responding as hot as it did in the past. But there's a second aspect to this, and we're going to look at it right here.
You have net long shorts in 10-year treasuries at the highest in many, many years, double where it was a couple of years ago. You get a short squeeze in yields the same way you get in the equity market, and then you see the yields come popping down.
Who's doing that? Who's shorting treasuries in real life?
Well, Ackman nailed it.
Yeah. Well, so you're going to have all kinds of hedge fund managers, momentum-related managers.
But that's a hugely negative carry. They can't keep that trade on for long if it's directionally not working. Like I think so. Ackman supposedly made $200 million, but he spent $100 million in carry to make that $200 million. So even if you're right, immediately, it's an expensive carry. So it seems to me like that kind of a short squeeze is the most likely outcome when you get that many people shorting treasuries.
That's a great point. It's a painful short.
So shorting treasuries is a very painful short. And I think that pain is coming to rest. Now, remember, Bill Ackman is famous for always going on TV and, telling his trade. He covered his position. Who knows if he really did? He said he covered his position on the bond short. And that was back here when we saw bonds peak. As soon as he publicly announced on Twitter, I'm covering my bond short. Why? Because the risks to, investors piling into bonds or U.S. treasuries for a safe haven is increasing, right? There's too many things going on, especially with the economy going forward. Maybe it collapses. Maybe we hit a recession. There's defaults and delinquencies. We see a lot of, treacherous growth indicators that become a headwind. So he covered his short. Bonds peaked at that moment. And the question is, are they done peaking? Well, the other aspect to this trade is if they keep holding their shorts, you just heard and who knows if this is actually fact, Bill Ackman paid $100 million to make $100 million. So, if you short bonds, you have to pay you have to pay a carry. So to carry the trade, you have to pay. So eventually it doesn't pay off to keep holding your short because you're going to have to keep paying for it, right? And that doesn't work out. So the carry is over. And you basically, too, that's all positioning and sentiment. We are looking at an all-time high record net negative positioning on U.S. Treasuries, meaning there's a record short, and that short is coming from what? Well, if they know that the U.S. is going to keep dumping supply, dilute the price, which makes price go lower, by the way, then you're going to tag on and short it. But if the cost to carry is too high over time, well, you got to cover your shorts, and this sets you up for a very violent rally, right? So these are the bond yields that we're going to see come down now. In inverse to bond yields, which is the actual bonds, we see an insane bullish divergence. Okay. And what is a bullish divergence? It's when price, actually it's starting to lift a little bit. It's when buying pressure picks up tremendously from the lows, right? You're extremely oversold. Buying pressure is picking up and the price is still lagging, right? Price is still down there. So we know there's also a record inflow in bonds at the moment because everybody's expecting growth to fall off at some point. So bonds are setting up for a sharp rally, right? You see the pressure continue to grow. It might just take one piece of data that is weak or the Fed pausing, which we get November 1st. It's probably going to be a hawkish pause, but you basically have positioning setting up for a sharp rally in bonds, which would bring these 30-year yields down sharply. Now, do they stay down? Do they collapse for the rest of the year? Likely not, but they would be easing, and the market is going to like that. The market's definitely going to like, bonds or bond yields easing because that's been a big part of the weakness. Now, the next part here. Okay, let's go to the third reason why we see a major market bounce, in my view. Okay, you heard me. I'm from Minnesota. Bounce, right? No, I'm just kidding. I'm not. But here's the third reason. Tame Oil. Tame Oil Prices. Look at oil prices. Oil prices are not really as treacherous as we thought. Okay, they're not as treacherous, and there's a real fundamental reason behind this, right? Which I've been keeping track of it. Maybe it does go to 100, but for the most part, oil is tame because demand is weakening actually, and supply is actually strengthening, right? So let's take a look at the actual data here that we got up on screen here on YouTube. Okay, the U.S. is the top producer of oil, right? They're the number one producer of oil in the world, and that production is at an all-time high for the U.S. or approaching all-time highs. So supply is coming online. That puts price pressures lower. On the second part, the U.S. is the largest consumer of oil, right next to China. And what do we see? So if you have supply coming online, and we're the biggest producer, so we're creating the most volume, that's going to put price pressures lower. And then we're the biggest consumer. So what do we see? U.S. demand is peaking. If we're the biggest consumer, but demand in the U.S., the biggest consumer is peaking in as far as demand back in September, and that demand is falling, then you get a double whammy. Price should go lower. And that's exactly what we saw, right? In red, this is U.S. demand, and black is the oil price. So when you get that combination, okay, of, tax loss harvesting ending, so buybacks come, right, starting in November, and then you have yields peaking because the cost of carry is too high. And on top of that, you can see that yields are not responding as strongly, and then oil is tame. Your macro picture is setting up for a Santa Claus rally. Is it to all-time highs? As I've been calling, maybe I'm wrong about that. We're down pretty far, but there should be, I think there will be a Santa Claus rally based on these macro fundamentals. On top of that, earnings are doing better. Okay, earnings are improving, as a matter of fact. As much as you hear they're weak, well, the interest rate sensitive sectors are weak, but mega cap tech is doing well. Okay, cap tech is doing well, and that'll probably continue going forward. Now, the next part here is, those are your three reasons why, okay? And the other part here too is just global liquidity is picking up. M2, this is money supply from the four major central banks. Japan just announced yield curve control today. That's more cowbell. That is more liquidity coming into the market from the central banks. China, we know, is tremendously stimulating their economy and their markets. That's more liquidity. And now you see crypto moving up, Bitcoin moving up, and everybody says it's the ETF. But for the most part, crypto front runs the liquidity cycles, right? Back here, when the Fed crypto actually peaked, okay, April of 2021 when inflation went up. And then it had a second peak November 21st. You want to know when this was? This was front running the Fed. This is when the Fed announced that they would be tightening, that they would shave their balance sheet. Basically, they would remove money supply from the system, and they would be increasing interest rates. Bitcoin peaked first. The overall stock market didn't peak till later, but Bitcoin saw that first. Now, whenever we had the SVB crisis and the Fed's balance sheet actually picked up, right? And actually before that, I'm sorry, let's go before that. There was some global issues, and U.S. dollar swaps exploded from the U.S. dollar swaps. We had to actually lend dollars to other countries, and you create more dollars. Well, liquidity goes up, and we saw that the dollar actually peaked at this moment, and the Bitcoin went higher, right? Bitcoin looked and saw that out. Number two, the banking crisis. Well, Bitcoin soared, right? So now this big move on Bitcoin, with the ETF is not even here. I think a lot of it has to do with looking forward to say, hey, the Fed has first of all, we're going to get fiscal policy. We're going to get more spending from the government. And that spending basically means there's more debt on the balance sheet of the U.S. Treasury. Well, who's going to buy these treasuries at the end of the day? The biggest buyer has been the Fed. And now if we look into 2024, at some point the Fed's going to have to step in, either cut rates, as much as they say higher for longer, higher forever. They're going to have to cut rates at some point. Because we do see the delinquencies coming. We do see commercial real estate weakening, right? And that just calls for more liquidity coming into the market. So when you combine all these macro forces, what you get is the market bouncing because it's extremely oversold. So let's take a look at the S&P, right? The equity market, for the most part, very strong rally today. Okay, very treacherous territory where we broke below the actual flag pattern. Okay, it got scary. It got to the point where you're like, oh my God, we're going lower much faster, quicker than we thought. And we bounced 408. Okay, and now we are moving back to the actual trend here. Now, forget the trend, right? Who cares about the trend at this point? The question is, are we back above the 200 moving average? No, not even close on the daily chart. We're not even close. But who's been leading this rally? The Qs. And the Qs are still holding above. This is technology. This is mega cap. They're still holding above the 200 moving average, right? And on top of that, we are testing the trend. Can we get back above? We'll find out. And this is going to come down to what? This is going to come down to Apple earnings, right? NVIDIA too, but Apple earnings, which comes on Thursday, which we will be live streaming for you. We're going to do Q&A after this also. And this comes down to the Fed, talk. I don't even think the Fed's talk matters as much. You have a lot of data coming in. Oh, let me remove this banner. We have a lot of data coming in for the year-end rally. I mean, that's what I call it, into November, right? And what is that data? Okay, the tax loss harvesting ends in 2 days on Tuesday. So you probably see the sell pressure, fall. And then there's going to be a muted response, which means people are going to wait on Wednesday. What does the Fed do? Is he going to pause? For sure, he pauses. We know that he's going to pause. We know that Powell will likely pause. And then the next question is, okay, if he pauses, what does he say? I think he's going to be hawkish, but I don't think the market believes that he can hike rates again because GDP peaked in Q3. Okay, the Santa Claus rally is here, but right now, forecast of growth, right? From the Fed now, GDP, basically you can forecast growth on a weekly basis, on a monthly basis, and that growth is lower in the fourth quarter. So there's no reason to hike rates. Inflation is not coming back. We're seeing more progress on inflation. Shelters falling, vehicles are falling. That's 2/3 of inflation. Okay, oil is the wild card. And what do we just look at? Increase in supply from the US, right? Increase in supply at the same time demand is falling because the summer months are the highest, produce the most demand for travel. All right. Now, can the war change that? Sure, the war could change that if it does materialize. But now it's been, what, a couple weeks, 3 weeks, and there's not much response. Okay, so at any time that could change. But for now, oil, the big threat, is not showing a threat. So if yields have peaked, that means the dollar peaks. That means the dollar falls and the dollar turns into a headwind for risk assets. Okay, and you'll see Bitcoin continue to climb. If oil remains tame at this 82 level, guess what? That sets you up for a very, very low, much lower inflation print into November, which is where I think the rally starts to take off in November at some point. Okay, so you're getting all these aspects to the market in your favor, and it feels treacherous. It feels, oh my God, this is falling apart. But at the end of the day, we're in a new era where the Fed communicates basically everything, and they're not going to stop. They're not going to allow the system to break. This is not 2008 or 2001. There's going to be a violent year-end rally, in my view. The last part to this that keeps the bull market, intact has to be earnings. You have to have better earnings. And so far, we'll take a look at the earnings here. So far, we have, or what we've seen is, we've had pretty good earnings. We are leaving the earnings recession. Let's go ahead and switch that up, actually. We'll switch this up to turn on the earnings. We'll go to FactSet. If you guys ever want to find how to look at the fundamentals, or you want to follow somebody on Twitter that posts pretty good content on earnings, right? It only comes every quarter. Actually, we're not going to go to FactSet. Let's just go to Twitter. They usually post the earnings, right? They usually do post the earnings and what the market is looking at. And we're not done with earnings. We still have Apple, right? Apple's going to be huge. Can Apple hold up the market? I think that we're just selling off into, I think we're really just selling off into a better earnings picture. And the other thing is too, if yields have peaked, then valuations and multiples can start to expand again, right? They can start to expand and look forward to more growth. The other part is once you get into 2024, I mean, we could have a recession in the second quarter. I don't see it in Q1 at all. Maybe Q3, maybe Q2, but you also have what? Does anybody want to think about it? Anybody want to say it? An election year. So I really doubt if any growth starts to fall that there isn't more stimulus coming in. Well, that's so inflationary. It could be inflationary, but if growth and inflation are down, it's going to be necessary. The Fed's going to have to deal with a little higher inflation rate. And we already know that historically, that core inflation is actually averaging at 2.8%, not 2%. So the Fed is using their expectations to get the market tame, right? To keep the market strong, tight, right? Tightening conditions. Okay, here it is. So let's take a look at earnings. Earnings aren't amazing. They're not great. Let's go to and look at P ratios are not even elevated now. The trailing 12-month, let's look at forward actually. The forward 12-month P ratio for S&P 500. Here we go. This is the multiple, S&P 500 multiple of 17.1 is below the 5-year average and below the 10-year average. What does that tell you? That stocks are not overvalued. And this is adding in the Magnificent Seven. So valuations have came down, right? And if yields start to drop, you're going higher. And earnings are still beating, you're going higher. IWM sucks. There's not a whole lot of market breadth because there's a lot of fear in the market. And there's not a whole lot of inflows, period. There's not a whole lot of inflows. The bond market is getting some inflows, but the equity market is not getting a lot of inflows because, they're competing with money market funds. But I think, again, you're going to have a stock pickers market here going forward. And those are, that's the trailing PE, but the actual earnings, let's go ahead and, I know they're over here somewhere. S&P 500 is reporting year-over-year revenue growth of 2.1%, which would be the 11th straight quarter of revenue growth for the index. So you're still getting revenue growth, a big drop in energy and materials. Okay. And then year-over-year growth on 2.7. This is the big one, which is S&P is reporting earnings growth, so EPS, earnings per share, of 2.7% for Q3, which would be the first quarter, the first quarter of year-on-year earnings growth since Q3 of 2022. This is the big surprise. Everybody knows this data is already out. The market's already priced this in. So the market, I think, already knows earnings are positive, but it is selling off because we have tax loss harvesting, and the market wants to wait for that selling to stop and wait to see what the Fed actually says and wait to add up the S&P, the mega cap Magnificent Seven earnings reports, which have been good. Tesla's been the only one who's really missed, right? Holistically, if you look at the whole earnings, and where bond yields start to peak a little bit after we see the Fed pause, right? Where are bond yields at? So I'm thinking this Friday, we get payrolls also. We get the employment report, and that's going to be huge. So again, I think this this employment report is going to set the market off because I expect the Fed to pause. Yields are probably done going higher unless the war really starts to materialize in a way that gets oil up again. This market's going to recover tremendously. Let's go ahead and go with Q&A, comments, whatever it is. If you disagree, let me know and throw it in there. I'm going to start shortening up these. I'm going to actually shorten these up and possibly do more per day. This one's focused on the macro. 3 reasons, right? 3 reasons why the market moves higher. We went over those 3 reasons. You can replay the video if you want to check that out. And number 1, tax loss harvesting ends in October for mutual funds. So selling pressures should slow down. Peak bond yields, right? We're going to see peak bond yields. They're showing a peaking in bond yields. Bonds are going to probably catch a bid here. And oil is not a threat, right? Yet. It's not a threat yet, but oil is not reacting because the U.S. supply and production is up and demand is down. And we're the biggest supplier and the biggest consumer of oil. That could change, but we kind of swing it there. So that's what we're looking at. We'll go back to the charts here and then I'll await if you guys have any comments. If not, we'll move on. If not, we'll end the video. We'll make it a little shorter. Got to get into that algorithm, right? Let me know what your comments are, your disagreements, whatever it is. Let's see. What do we got? Who do we got first? What up? I didn't even see. Oh, why is Tesla so low? Oh, yeah. Tesla's getting smoked. Tesla dropping like a rock. Yeah, Tesla dropping like a rock. Part of the reason Tesla got smashed here, we'll take a look at Tesla. We'll keep it on this chart. There's a couple reasons Tesla's getting crushed on top of the fact that there's growth concerns because of higher interest rates. But there's a lot of FUD in the market for Tesla. And the bears are winning. Nice downtrend there, right? Pretty good downtrend below the 200 moving average. But for the most part, I believe it's on semiconductor got smashed. And I'm sorry if you guys are holding that. On got smashed. Now, On provides chips for cars, and they basically said the demand for chips for automotives is down tremendously. So they're signaling, dang, that was a big drop. They're signaling that the demand for electric vehicles in general is not as strong as expected. Therefore, Tesla, you add that onto Tesla. Okay, you add that onto Tesla. There were some other, well, not Tesla, but you add that as the sentiment that, oh my gosh, Tesla isn't going to be able to produce or sell as many cars. On top of that, BYD, which is their biggest competitor in China, smashed expectations. Okay, HSBC cuts price target but cites continual growth. So BYD really beat expectations in China, and it's, that's the main competitor in China for Tesla. So your competitor's doing better, you're cutting prices. A lot of fear there. Next FOMC, who we got here, Jervon. Next FOMC meeting looks similar to the last meeting. Pause and hawkish tone. Exactly. Pause, hawkish tone. I don't even think it's that important. I think the market already prices in what Powell's going to say. There could be some surprises there, but I think there's going to be a pause, hawkish tone, and it's going to be the employment report that could scare or fuel another rally. And I think it just takes one. It's just going to take one, one good catalyst, because the market it's like a seesaw, and the seesaw is leaning extremely bearish, extremely negative sentiment, on top of good earnings, on top of Tame Oil, on top of the Fed pausing, on top of bond yields possibly peaking, which takes the dollar lower, which becomes a headwind for risk assets in general and valuations. So yeah, we'll see what the Fed does. I mean, everybody's going to be focused on the Fed. The Fed does move the market, but I think we kind of know what the Fed's going to say, of course. And it's going to come down to, what those payrolls look like, and Apple earnings are going to be huge. Maybe the weakness is already priced in. That's what my guess is going forward. Any other comments, questions? What do we got here? What up, Big Man's coming? Appreciate the support. It's a bloodbath. Yeah, it's a bloodbath. 180 to 200, huge buy zone. Yeah, and there's some crazy, going back to Tesla, there's some crazy volume also being done here. This was a previous level. It is looking pretty bad, but I mean, here's the positive part. Look at the RSI, right? Every time, and I know the RSI is signaling selling pressure, so it can get worse, but it is like a rubber band. The rubber band is pretty much at max stretch, right? It's pretty much stretched out. It's like pushing. I always say this. The analogy is, the more you push a beach ball underwater, it's not incrementally easier. It gets harder and harder to push it, and there has to be a release valve, right? We're going to get that release valve, and that's where you say, okay, can we continue back to the highs, or do we come back up into the zone, fill the gap, and then reverse back lower for Tesla? That's probably going to depend on the overall market, but there will be a bounce here for Tesla. And if you're a long investor, you don't care. If you have long options, you don't care. If you're a short-term trader, you got to be careful. You got to tread this carefully. Always getting bad news to death, then it rockets. Yeah, exactly. There's going to be one last capitulation. Today it did support off of a gap. It was a 193 gap. It supported multiple times off that gap. Watch, let me change it to the actual trading. So we hit this gap multiple times. I've been watching it. And yeah, it's weird because there's on TradingView, it doesn't show, but there's a bunch of capitulations, big buyers stepping in, and the relative volume was pretty strong today. So it's holding up at this level. It's forming a base, and you really want the Qs. You want the Qs to form a base also. And if we look at the Qs actually bounced, got above VWAP after getting rejected twice, institutional buyers rejecting it, and then got back above. So again, oil is pretty tame here. The Qs are up for, I would say, a third day in a row, and much stronger than the S&P, of course. If we take a look back, the Qs did fall off of a big level. We need to get back above 355. No doubt about that. But again, the real catalysts here are going to be Wednesday, Thursday, Friday. Wednesday, Thursday, Friday. Would you add to your Tesla position? Yes. After seeing this low, I will add. I'm down. Listen, I'm down on my Tesla position, but it is pretty far out. It is pretty far out. Like I said, I'll sell against it. What I see forming here, and let me switch back because I can't draw on this chart. What I see forming here is a reverse head and shoulders. I think the move is overdone. Okay. Now, have I had the best risk management? Hell no, I haven't. Hell no. I held during earnings, and that screwed me up. And I've been buying on the way down, a little far out, so I could get screwed here. I could lose money. I could lose a lot, right? But I'm optimistic that the overall market is oversold. I'm pretty optimistic. I'm always optimistic. Whatever, you want to be a pessimist, great. So my thing is, look at this reverse head and shoulders. Let me switch to this side. Let's go to the 30-minute chart. Just showing you how there's a lot of things I could have done better. So reverse head and shoulders. Here it is. Right, here's your reverse head and shoulders. We broke down, right? Now, if the overall market gets slammed, Tesla's going to go much lower. It's going to be treacherous, for sure. But again, we just went over the 3 reasons why we do bounce. Tax loss harvesting should be huge starting Wednesday, Thursday, Friday, when mutual funds can start buying back the stocks they actually want. They had to get rid of a lot of the ones that also. The tax loss harvesting also accounts for bond funds. So if bond funds, if the selling ends for bonds, you're going to get a pretty vicious rally in bonds, which is a vicious rip, correction for rates. And rates are going to, Tesla's very sensitive to rates. So is crypto, a lot of risk assets. So here's your shoulder. And I said, hey, we might get another head. And we did. Here's your head. So I think we come back into 205. And then we'll see if 205 comes back down and creates another shoulder. It looks like it's forming a reverse head and shoulders, but more so, sideways, not straight up and down. These are usually a little more bullish, I would say, because the selling pressure is so strong going into it. Oh, what is this? Right? So we'll see how this plays out, but that's what I'm seeing here. Let's make this a little thicker. There we go. Right, we might get something like this. Let me redraw that. Here's your shoulder. Here's your head. Come up to what, 205 something. Come back down one more time. Maybe we even retest the lows. I'm not sure. And then here's your breakout point. But you want this breakout to coincide with, a more constructive Fed, a more constructive macro. The dollar comes down. Earnings are still pretty positive for the Mag 7. And oil doesn't rapidly increase. There's no war, and this is really, like I said, it's very oversold anyways, right? It's very oversold, and I think we're gonna bounce here anyways. Look, there was also some good news for Tesla. Also, there was some supercharger networks. Why isn't my RSI coming back? What the hell? The supercharger networks were also there. It is. The supercharger networks are expanding, so they're underneath the hood. They are growing. They are expanding the network. But again, Tesla's a very traded, highly traded stock. So all the catalysts have to align in one way or the other, and they've been negative so far. It'll run on bad news. Yeah, bad news. When you get there you go, big man's coming. Usually you get an overreaction, one more piece of bad news, big capitulation. Stocks bottom on bad news typically because it's already priced in, right? All the big drawdown was pricing in a lot of the weakness already. Amazon looks great, by the way. Just remember, when it was running, everyone was wanting to short around 240 level, and then it got to 299. Yep. And there's big buyers stepping in here. We know a lot of funds are going to step in here and buy this. Ford sucks. GM sucks. And, Tesla's more of a longer term. Actually, it's a lot of things, so I'm not going to really put a tag on it. But I think it does capitulate. And the question is, how strong does it capitulate when it does come? Would you add to your Link position? It is really tempting. Link, I've been watching it, and Chainlink has been holding on here. It's showing some bearish divergence here. Okay, the RSI is low and price is high. This is bearish. But the one thing that I've learned about crypto, the safe bet is to wait till it comes back down to 10, I would say. I want to see it come back to 10. And then I would add. The thing about crypto is these altcoins, when they move, they can be oversold a long time, especially at the beginning of the cycle. And like I showed earlier, global liquidity, crypto responds most to liquidity. And when we take a look at liquidity, where's the liquidity at? Global liquidity is picking up, right? This chart right here. This is the M2 money supply. And also crypto's looking at, hey, the Fed's going to have to buy back the debt. They're going to have to reverse course in Q4. Oh, but they said that they're not going to cut rates, that they are going to keep shaving off the balance. So did they said the same thing in 2021, that they would not stop. And they did, that they wouldn't increase rates, and they did. So it's all data dependent, which is why we track the macroeconomic data. So Link is looking great. It looks great here. I like Link. It's moving still. It's strengthening against Bitcoin. It's forming a wedge against Bitcoin, against Ethereum. Right. Let's make that a little bigger. So it is strengthening, but you could have a breakdown. You just never know. But I would add. Would I add to it? Yes, I'll definitely add to this. I want to see it test $10 again. I really want to see it come back to 10. I don't know if I'll snag anything else. Maybe 10.50, but that's what I'd like to see going forward. This pullback should be an opportunity to buy stocks for cheap. Yeah, there's a lot of stocks that are looking good. There's a lot of stocks getting wrecked also. So everybody, we need this big bear market. Well, we are technically in a correction now because the S&P is minus 10%. That's a correction. Minus 10% is a correction. Minus 20% is a recession or a bear market. So we're not at bear market yet. Morgan Stanley's Mike Wilson says he doesn't think this rally has legs. But hey, we've been saying that this would be the biggest bear market rally of all time if it were the case, right? If that were the actual case. And he's long. He's only 5% cash. Like he's super long. And I think people are betting on these bonds because bonds show a lot of upside from what I understand. And if bonds go up, dollar comes down, yields come down, stocks go up. So I think it's still a good setup. It's just a washout. It's psychology in my view. And even if it goes lower, you can still buy more. Yeah, if you're an investor, this is the perfect time to invest. If you're investing for the next 18, 2 years, 3 years, this is where you buy. This is where you get long, you get bullish when everybody's fearful, when there's a monster sell-off, and there's a really good setup going into next year, the election cycle. Stocks always do great in an election cycle. 300 new highs for Tesla. Yeah, 300 is going to be the big one. Tesla's volatility is really high. It can bounce or fall strongly. One con I see is that price is riding the bottom of the Bollinger Band, a strong sign of downtrend price action. Let's see that Bollinger Band. I have the Bollinger Band on here. Let's see. There we go. There's that Bollinger Band. Let's take the EMA off. Oops, did that backwards. Pull this off. Oh, okay, yeah. This is the 4-hour Bollinger. So yeah, it is treacherous. It's gonna take a catalyst. I mean, it's gonna rebound. The question is, does it rebound with strength or rebound and then go lower? That's really the question, which you probably already know. But yeah, on the daily chart, man, it is scraping that lower end of the Bollinger Band pretty strong. But we've had 4 days of selling. This has been a big sell-off. Keep in mind, from the highs, right? From the highs, you're down. You got down 35% on Tesla, right? You got down 35% from the last highs. It came down 29% and bounced. And then we had, actually, let's go to this one. Let's use this. We had 29% bounce. And then here we got 29% bounce. And then here from this next high, 30% bounce. I think we bounce here unless really something gets worse. But I think looking at the price action today, if the overall market, if the Qs can hold up here, if the Qs hold up here, Tesla's going to hold up and squeeze a lot of those shorts in my view. Tesla rip or dip. Who else we got? 200, 220, any lower, get in there. Yeah, 200, 220. My bottom was 200 and it got down to 191 today. That was pretty insane. Tesla rip or dip. Yep, that's right. But listen, overall, yes, Tesla could go lower, but your probability based off the momentum, right? Momentum's going to return back. I don't want to say to the upside for the rest of the year, even though I still think it could. Momentum's going to bounce. You still have to get over margins, over revenue, over production, over full self-driving. You got Cybertruck November 30th, which is 1 month from now. You got 30 days, and I think that's going to be the next catalyst. A buy the news event into the Cybertruck, and then a sell-off right after the Cybertruck. I don't want to say is released, but when they start delivering, who knows when the end point to that catalyst will be. Maybe we'll only get back to 245, but this gap will get filled eventually at some point. So yeah, it's very oversold. I think we're gonna bounce. This was the most oversold since that big dip in January, December. But if you go to the weekly chart, okay, it tells a different story. The weekly chart tells us, oh, what the heck? Why isn't it showing it? The weekly chart still has room to come down. So there's your bear case. We come down to 179? I think you had carbides, something like that. Oh yeah, carbides has the best TA in the chat. I wish my trading was. I feel a bounce soon. Yeah. SPY is up. Qs are up. Mag 7 is up. Tesla's down hard. This is something to keep in mind. We could get a pump, but when everyone is up and you're down, that's overwhelming selling pressure. Yeah. That's why we need the overall market to bounce. I mean, Tesla's negative catalysts, I think, are going to run out of negativity pretty soon here. But what is pretty soon, right? We got to get past the Fed meeting, I think, more than all. And they're super, like 10-year rates are the most sensitive thing to the market right now. 10 to 30-year rates, that's where you make or break it on the 30-year rates. And I do think 30-year rates are close to peaking out here. They're just not responding the way that, I mean, they could make a new high, but they're not responding definitely the way they were. And that's a bearish pattern, even though that hasn't mattered this whole year. They haven't been responding as strong as they have been to stronger data. I think they're just waiting on what the Fed says. The what is the Fed's outlook going forward? What is the visibility for rates in the economy going forward? QQQ on the daily, yeah, we'll do QQQ, and then the dollar here. If the dollar happens to slip, that it has some bearish divergence, that's going to be positive for risk assets in general. We'll take a look at QQQ here. So QQQ, this is the daily chart. I mean, you got strong support here at the 200 daily moving average. We'll see if it ever comes into that. And also, let's throw on these EMAs. Those are really laggy. I'll take this 10-year off. Here's something that I haven't looked at for a while. I'm going to take off VWAP. I don't really care about VWAP. Where's the anchored VWAP? I want anchored VWAP. Anchored VWAP gives you a different way of looking at things. I know it's on here somewhere. There it is. Anchored VWAP. There it is. Anchored VWAP. So what I want to do is I want to see where anchored VWAP is from the previous lows. Actually, let's just go to the yearly lows. Yeah. So anchored VWAP tells you we could come down to 322. That's anchored VWAP. If we move it up to the January for this year, we're pretty much at anchored VWAP. I mean, we still have a little more room. We can get down to 10 more points. If we move it to the banking crisis where all the volume came in, then we're really at anchored VWAP. So this is a pretty important area of support here for the Qs, and it comes down to earnings. It really does come down to the Mag 7 at the end of the day. So that's why I'm more focused on that. The Qs will move with the Magnificent 7. Fund managers are offsides. They're gonna have to buy into this. I mean, when you're down this much on the Qs and you tax loss harvest out of these trash companies or mutual funds, trust me, they're gonna come in and buy this AI. Also, to take a look at it, let's go to the weekly really quick. What's the weekly looking like? The weekly is I would say the weekly actually looks a little more bullish because you have the 50-day crossing above the 100-day, and the 200 is still the slope is still higher for the 200. 200 moving day average, our weekly average is sloping up. The 50 is sloping up, and you get the golden cross there. So this was a very sharp sell-off. I mean, how much are the Qs down at the peak? 12%. Right now they're down like 10%. So correction territory. So this is a meaningful correction. It's just a pure correction. Now, if we were to go to the 4-hour chart, let's take the SMAs off and just look at price action. Okay, there's a gap to fill up here at what, 357. We have to get past 350 to 351. 350, let's just call it 350. 350 is the big level at the moment. That is our last line of support resistance. That needs to get flipped. So 350, and then from 350 you got 357. Those are your two levels for the Qs. And on the downside, you're pretty much at the trend. If you get rejected at 350, which we did twice over the last couple of trading days, well, we could dip even lower, right? But you do have a lot of the most important data coming in, so we'll see how that plays out. On the downside, what, 345? We might retest 345. Man, this is going to be if we do get to all-time highs. This is I'm thinking now we get to the year highs, right? If we do get the Santa Claus rally, I think it comes to the year highs. All-time highs, possibly, but you need a lot of more positive catalyst if we were to get there. Yeah, Tesla was doing the opposite. Yeah, Tesla's wild, man. There's a lot of traded options in Tesla. So you give it like 3 or 4 days, and I think it really does come down to the macro. Obviously, higher. If Tesla investors see peak interest rates on the 10-year, and the Fed does pause, I think that's going to be enough to get the train moving again. If that's true, Tesla's highly susceptible to crowd psychology. Move. Oh, I didn't even read it. I read it in my head. I've heard that Tesla has a low amount of institutional trading. I think the institutions trade it a lot. They just don't own a lot of it. It's the lowest owned out of the Mag 7 is the least owned by institutions, which means it does have a lot of volatility. And that's what it does. It's probably going to be like that for a while. All right, so that's what we have. Let's take a look at crypto really quick before we end. Let's do some Bitcoin analysis. Okay, now Bitcoin's above this level for the first time in over a year. Can't even scoot back there. And it is forming a giant, I mean not giant, but a pretty big wedge pattern here. Right? It could come back to here. Probably come to here. So this is a big wedge pattern that it is forming. You could measure the wicks however you want to measure it. I'm going to make it a little bigger here. Let's just say this is the wedge. Right? So that's what you're looking at. Big flag, right? Big wedge pattern for Bitcoin. That's weird. Why does it light up in some areas and not in others? Either way, yeah, you got that big wedge pattern. We'll see how this plays out. I think it's going to come down to rates also. Ethereum, price action always looks weird on Ethereum, and it just breaks out. It has the weirdest price action for sure. Let's get this back down to dots. So Ethereum, you never know. It just looks weird. It kind of has a wedge there. Bitcoin's still dominating. It looks like for Chainlink, it is starting to roll over. You could see it a flat, 1150. I think 1150 to me is the area for Chainlink to break. It needs to hold 1150 and make that second run. And it is still trying to move against Bitcoin and Ethereum there, especially XRP. Oh, XRP gaining some dominance lately. What else we got? I think we have one more leg down so NVIDIA can fill those nasty gap ups. Then we bounce maybe. Yeah, you still got NVIDIA earnings a little further out too. So the market might I think the market's going to bottom out pretty soon here. And then we have a run up, and then maybe we run up until NVIDIA earnings. That's not till the 21st. And then the market can decide whether the AI is enough to increase productivity and move higher. So we'll find out how that plays. I do sense a bounce based on price action lately. SPY has a healthy bounce today. I want it to stay over the 21 EMA on the 1 hour chart into this week. 21 EMA. I got the 20 EMA on here. I don't have the 21 EMA. See what this is looking like. Oh, okay. So yeah. I also heard if you're familiar with the guy who created, I think Brian Shannon, he created VWAP. He says he uses the 5 moving average. He says if the 5 MA is pointing downwards momentum, it's all up to Apple. Yep. How's Apple looking? Apple's really setting up bullishly in my view. I don't even think the earnings matter. I know it sounds stupid, but I don't think the earnings matter as much if the earnings are not a huge disappointment or huge surprise. I think it's just if they come in line with expectations, I think Apple is just cocking back, getting ready to break out. I mean, that's a very bullish pattern. When it moves, right? I mean, it came out of this pattern earlier in the year, falling flag, right? This one's even sharper. So I think you're setting up. I still think we're going to get a rally here as long as nothing crazy happens on the macro. That's what the setup is. Right? Okay, we're coming into 49 minutes. It's all up to Apple. Yeah, let's do a little refresh here. Little refresh is, like I said, I wanted to shorten these up a little bit more going forward. Number one, tax loss harvesting for the money for the mutual funds that ends. Okay, that's going to end in October. Not all of them, but a good amount of them. This came out from Barron's. So selling pressure is going to slow down into November, and I think everybody's really keeping their eyes on the Fed. What is the Fed going to say? How are Apple earnings going to come out? What are the payroll report going to look like? And that's going to be what we're looking at. Do bond yields finally peak? The cost to carry the short is very expensive, and so far they haven't been responding to higher GDP, higher spending, higher inflation, a little bit higher inflation expectations. They haven't been responding to that. So I think yields are pretty much peaked out at this moment for the rest of the year at least. And at the same token, if the Fed does pause, depending on how they pitch it afterwards, bond yields could really collapse, right? If the war escalates, people see that as very bearish, but there could be a flight to safety into U.S. Treasuries. This is a great opportunity. If you go to HYG, it is a high yield bond ETF. HYG is yielding 9%. So there's going to be a lot of investors looking for that fixed income. That'll stabilize the equity market. And number three, like I said, oil is tame. The U.S. is pumping more oil. Okay, we're at a record for production of oil, and that's going to increase. At the same time, demand in the U.S. is falling. So that sets you up for muted oil prices, which we've been seeing. That's my macro I got for you guys today. I'll read a couple more comments, but that's the macro I have set up. Call Jerome Powell to make the market bounce. Yep. All right. Well, that's all I got for you guys. I appreciate you guys joining in. If anything else new pops up, I'll be on again. And hope you enjoyed the newsletter. We'll get that fixed up. Still working on the course. If you guys are interested, if you're new, working on a course, investing, macro cycles, all that stuff. Pretty much everything I know, how I view the market, macro, technical, and fundamental analysis. So I'm still working on that on the side. Anyways, appreciate you guys joining in. As always, stay blessed. Have a good weekend. Make sure you get your workout out today if you had too much fun on the weekend. And stay safe. I know it's Halloween tomorrow. Stay safe. You never know. And we'll stay updated on the war. All right, guys, stay blessed. Catch you guys later. Thank you. Thanks again.